What's going on, guys? Welcome to this week's Market in Focus. Wrapping up October. Today is October 28th. My name is Hamilton. I'm here with the Trading Initiative, and over the next 5 to 10 minutes, we're going to look at what went down in the market over the last week. If you like this type of content, please like and subscribe. Comment below. Let me know what you think about it, how we can improve it, etc. And let's get started. First things first, big winner week over week, Bitcoin. You don't have to be trading Bitcoin to have seen the headlines. We were up and over 30K. Over the last week, we are up 15.26%. And over the last 3 months, we were up 17.1%. The only thing I'm going to say about Bitcoin, other than the fact that it is outperforming everything right now in terms of asset class, is that it is decoupled, right? There's this classical relationship between Bitcoin and the growth market. Generally, they are positively correlated. The Qs go up, Bitcoin goes up. The Qs come down, Bitcoin comes down. That has decoupled over the last few months, and right now there's huge overperformance in Bitcoin, lots of relative strength. So that is something from an intermarket relationship standpoint we're going to have to take into consideration. Is there a permanent decoupling of the NASDAQ into Bitcoin narrative? Is this entirely because of the ETFs that are supposedly about to be approved, etc.? We don't necessarily care why something is happening. We just need to observe and potentially trade that it is happening. So Bitcoin, big winner this week. Copper up slightly. Bonds week over week, that TLT up 1.36%, but the narrative here is it's down 14.27% over the last 3 months, and over the last 6 months, 18.11%. Bonds are actually breaking into potential all-time lows. We're going to look at that on an absolute basis on TradingView in a second, but TLT looks very, very, very weak here. We're going to see if next week the market can push this thing into all-time low territory. Very, very, very weak bond market right now going on. You can see the rest of the indexes here are down on the week, either in between about 2 to 3%. You see SPX, IWM, the Qs, all three of them down, right? SPX and the Qs are breaking into new like 5 to 6 month lows. And IWM actually just broke down to a 3-year low. So there is a lot of risk off sentiment in the market right now. We'll look at all three of those indexes shortly. And let's go ahead and wrap this portion up with crude. Crude is down 4.34%, right? Crude is down 4.34% this week. It's still up massively since June, but this was a rather volatile week given geopolitics, some of the positioning and some of the largest speculators, etc. Primary uptrend in oil is still up. Intermediate trend is still up, right? That intermediate trend starting back in June, but the short-term trend is very convoluted right now. We need to see on an absolute basis if we're going to bounce off that 80 level or if we're actually going to break it and potentially come back down and test in those 70s, because guess what? The Biden administration wants to own or at least refill their SPR in that $70 range. We'll see if they actually get it. Let's go ahead and take just a quick peek on U.S. sector performance over the last 3 months and industry performance just to get a general idea, right? We want to see what's working, what's not, if there's any longs opportunities from a sector standpoint, or should we be, totally looking at shorts here. Energy. This was the only sector that was still holding up coming into October. Every other sector was down and pressing into new lows. For the most part, energy is starting to potentially come down as well, right? We saw big earnings reports come out yesterday. CVX, XOM, CVX capitulated, like down 6 or 7% on the day. CVX is the second largest holding within the energy sector. It is a huge company, and it was down 7% in a day. That is a big deal. XOM down also, I believe, around 2.5% yesterday. So huge moves in XLE. Look at everything else, though. Real estate continuing to underperform. Utilities potentially finding a floor, but still down 13.44% over the last 3 months. XLY or consumer discretionary names, Amazon, Tesla, etc. Industrial staples. This just looks like an entirely risk-off type of market right now. Unfortunately, this is not something that we want to go and buy. And if you're looking to short, you really want to be aggressive with these shorts in terms of your time frame. You don't want to sit in these shorts for the next 6 months. We peaked. Stocks peaked at the end of July. So this is a multi-month downtrend now being confirmed below the 200-day moving averages in a lot of the indexes. Correction territory in SPY. So if you're going to be opening up shorts, be aggressive, be smart. Don't be Michael Burry, but there's a lot of weakness in every sector. Even XLE, like I said, it's starting to show weakness here. Over the last 3 months, you can look at an industry standpoint as well. Look at solar and clean energy. Over 40% drawdowns in the last 3 months. That is just indicative of liquidity leaving the market. These were the higher beta names. A lot of these popped back in 2020/2021. Lots of meme stocks, etc. They are down massively. Jets as well. Airlines down 30.83% over the last 3 months. The only real stuff that's holding up still, energy related stuff. But realistically, do you want to be going out and being buyers of energy right now? I mean, pick your spots if you are, right? Because there are cracks in the wall, even for the energy sector. Everything else, other than maybe GDX, right? We'll look at gold in a second, but everything else just looks like complete crap. This is not something you're going to want to really go out and buy. With a lot of purchasing power, if you're a short to intermediate term trader, you're going to be bucking the trend. If you are, downtrends are very prevalent right now. Last thing we're going to look at here is factor analysis, just to get a general idea of what market caps are working the best. Realistically, it's still the large caps, right? Large cap growth, large cap value hanging in there. The small caps and the mid caps are indicative of risk. Where is risk going? Out of the market. So why would people want to hold mid caps and small caps? It makes no sense. This is not the time to go and buy the dip. Not yet, at least. I mean, we need to see a strong reversal candle, etc. And smalls and mids are getting absolutely slaughtered, right? So before we get into actual trading view, we kind of have this framework. It's bearish. We saw what was up, Bitcoin, but everything else is relatively down. I want to go ahead and point out, we look at one tweet during the market and focus and just kind of analyze it really quick. From Ryan Dietrich, he posted the average year for the S&P 500 bottoms today. That was yesterday. I just want to look at the chart here. Stocks bottom on October 27th. We were talking inside of TTI, obviously October 27th, yesterday, was a very big down day in the market, all things considered. Was that the bottom? Historically speaking, average, it was. Do we think it is? Probably not. We think there's probably going to be more, at the very minimum, short-term pain coming in. We haven't really got those capitulation candles. But I think it's important to understand that on an average year, stocks tend to bottom on the 27th of October, as shown here by Ryan Dietrich. And then they begin their end of year rally. So, I mean, if that does end up being true, right? If Friday's close does indicate the actual low, what better low can you possibly ask for than, for example, IWM pressing into 3-year lows, SPY officially confirming a correction territory down 10% off of its highs? You couldn't write up a better Hollywood script to bottom on the day that everybody is officially going to start flipping bearish. Just keep that in mind. Okay, so let's actually go through some of the absolutes here. First thing I want to look at, not actually SPY, although, like I said, we have officially entered correction territory. We're down over 10% from the high back in July. We're underneath the 200-day moving average. This doesn't look great. The 410 area does have a pocket of high volume. As you can see, we started to bounce. VRVP is telling us that there's a lot of volume here, right? Your VRVP indicator shows you volume by price. This level right here, for whatever reason, was very, very active on the way down and on the way up. That tends to bring sticky price action. What does that mean in the downtrend? Well, if you take Ryan Dietrich's historical data at face value that yesterday was the low, volume does tend to confirm that. So we'll see, right? We don't like the RSI down here ranging below the 50, so we will not be buyers off of this. Even if there's a bounce, we want to see some constructive movement to the upside. But hey, it could happen. We have no idea. The markets are crazy. Let's look at the yields really quick. So yields were hitting new highs this week. This is insane. If you go back a few markets and focuses ago, like maybe 2 months ago, we were talking about when the yields were potentially going to break out here, and everyone said, no way. There's no way yields are going to hit 5%. The Fed's going to step in for, whatever. They hit 5%. As a matter of fact, at one point this week, the 30-year, the 1-year, the 10-year, and the 2-year were all up and over 5% at the same time. It was pretty wild. But I mean, the moral of the story is we're in an uptrend. This is an uptrend, right? We had a base pattern. We had a horizontal level break. I mean, this is a structural uptrend in yields. You have to assume that these things are continuing to go up until until the trend is done. That's how technical analysis works. Our job is to analyze trends, find them, and play them. If you're a trend trader, which every technical trader is, even if you don't trade with the trend, you have to assume this is going to continue to go up until it doesn't. This is new highs in yields, new lows in bonds. Quickly here, let's just zoom out on the weekly. I mean, there's record inflows right now on bonds. Look at this. We are hovering near all-time lows going back to 2002. Is this the week that it bounces? It could. I will point out that there is a slight bullish divergence forming on the daily. You could kind of see it on the weekly as well. There's a slight bullish divergence in TLT as RSI hits higher lows and price hits lower lows. Bullish divergences typically front-run reversals, but these can take weeks, months, or even sometimes years to play out. So this is not something you want to take the immediate trade on, but it's nice to see that momentum to the downside is slowing. All right, dollars, we're hitting new highs. We consolidated here above that 105.5 area and potentially broke out Thursday and Friday. Do we continue up? We're not entirely sure, but we will tell you that as the dollar continues to break out, stocks will continue to have a hard time to rally. It's an inverse relationship going back the last 2 years. It's continuing to hold. Every up day in the market for the dollar tends to be a down day for stocks. So something to consider there when you're setting up your game plan for the morning or when you're looking at stocks to buy. What is the dollar doing? We said Bitcoin broke out into new yearly highs. Here it is. Fantastic move. We did get long off the 200-day moving average breakout. We made a couple videos on this and put some trades out on Twitter. We grabbed some BTC miners, etc. Cool trade. Why not? What's not to love this above the 30K level? As long as we start to build a base above this 30K level, why is this not the bottom? Why did we not bottom way back at the beginning of the year? This is a structural uptrend. We're above the 200-day moving average. Volume is confirming the breakout. RSI is above 50. There's everything to love about this specific chart right now. It is a little up there. So if you're looking to establish a position right now, you might have a little bit hard time, but continue to watch Bitcoin. There's lots of different opportunities there to trade it in the equity world. You have your Mara, you have your Riot, you have your GBTC, etc. Talking about GBTC, gold. Look at this, $2,006. This is a very, very nice fractal here going back 3 years, right? This is a 3-year basing pattern up and over previous all-time highs. We absolutely love this. We also got long this about 2 weeks ago, up and over the 200-day moving average with GLD and AGI, a gold miner, and straight spot gold exposure. It's working for us. We like this. We expect this above 2K to eventually test the all-time high at 2050. We're not 100% sure that it's going to break out at that point, but if it does, we do believe that this is going to have a push up towards potentially $2,300 in the intermediate time frame, and that's what we're positioned to grab. Gold all-time highs, not that far off, or less than $50 off, not a bad place to go. We talked about all the different indexes down. We're just going to briefly look at them. Like I said, SPY's in correction territory. You can look at the Qs, doesn't look great, coming down and potentially testing that 200-day moving average. August highs are where we're looking at a potential reversal for us. We have no idea if it's going to happen, but we're going to be looking for it somewhere around that 33 area, right? $330, that area. And then once again, IWM, 3-year lows. 3-year lows. We've taken out the entirety of the post-COVID pop. We were range bound for a year and a half. We've finally resolved to the downside. This is very indicative of risk off. This is not something we want to buy. This is part of the reason why we expect Friday not to be the actual low. We need to see small caps stamp out some sort of low. Look at the volume on the breakdown. Look at the RSI. Incredibly bearish price action in small caps. Buy when there's blood in the streets. It's kind of bullshit for us. I'd prefer to wait for somebody else to throw their hard cash on there, find the bottom, and I'll participate after we bounce a couple percent. I don't need to time the bottom. I don't need to post stuff on FinTwit to say I did it. I don't care. I'm here to make money. I don't want to time that bottom. So oil, like I said, we have a primary uptrend going all the way back to when oil was trading at negatives, right? Primary uptrend here, intermediate uptrend starting back in June. Nice to see, but in the short term, we have had a pullback. Are we going to get some sort of bounce at that 80 area? We're not entirely sure. Oil was down week over week by about 4%. So we're looking at this because we do have some exposure both in oil and some energy companies that are working. We don't want to continue to add here if oil is below 80 though. So we are very, very tentative of this $80 area. By no means does this absolutely have to bounce. If it breaks below 80, we were wrong. We'll stop out. That's totally fine. I don't care about the geopolitics at all. We're seeing a series of lower highs followed into a support level at around 82. We'll make the decision if that happens. But we do think that if this does bounce, which we're still in that camp, we do think that it will. We're not 100%, so we're watching the position. We do have a target of around $100. Last thing to talk about really quick is your financials. Financials. They are shitting the bed, guys. Financials, oops. We want to look at XLF here. XLF is looking like crap. Some of the larger major banks here look like crap. This is not great, right? IWM resolving to the downside. XLF looking like it wants to resolve to the downside. This is not a good look for the future of the market. This is not what you want to see in terms of sector hierarchy. Generally speaking, if we were going to bounce and start this Q4 rally, we would want to see it in financials as well, and we are not. As a matter of fact, there are some charts that are capitulating. If we want to look at KRE, which is a regional banking ETF, it's the more higher beta, higher risk, smaller banks. We can see that we're pressing in towards those May lows. If you don't remember what happened in May, this was when regional banks were blowing up. Yes, we bounced, but we have almost come all the way down and hit new lows. So there is something going on with the financial sector that the market does not like. We do have a short on Morgan Stanley right now. It is working for us. We did get a move on Friday to confirm it, right? We're up about 50-60% in this trade. We're not anywhere near where we want to close half of that 100%. Contracts are moving a little bit slow, but nice move on Morgan Stanley. We're up. The other trade I want to highlight, and then we're going to call it a session here, is this UPS trade. We did short the UPS trade. If you can see both of these setups, Morgan Stanley and UPS look the exact same. That's on purpose. Big horizontal level base going back 2 to 3 years. No volume underneath. We want to short through a capitulation moment. And boy, did we get one on UPS. Most of us closed half of our positions or full positions in between 60 and 100. We do have a bunch of traders though, or a couple traders, I should say, that held runners through the ER event, and they are up anywhere between 250 and 400%. So congratulations. If you're one of those traders that held through the ER event and the subsequent sell-off through the last 2 trading sessions, Thursday and Friday, good job. This is not the market to dump a bunch of money in. Even if you're looking to go short, be aggressive, be advantageous, find the setups that you like, and take the shorts. Don't be afraid to take profit a little bit quicker than you expect, because any sort of dead cat bounce is going to absolutely kill your premium that you work so hard to grab. Guys, my name is Hamilton. I'm here with the Trading Initiative. Once again, if you like this type of content, please like and subscribe. Leave comments below. General assessment here is risk off. You know, this is not the market to go and dump your entire account into shorts, but holy shit, the market does not look good. Internals look bad. Breadth looks bad. Most sectors are down. Be careful out there, guys. We'll see if Friday ends up being the floor or not. And if it is, hey, maybe in the next market in focus, we'll be looking at potentially buying some undervalued parts of the market. Catch you in the next video.